everyone, welcome to another session of product terminology. So today we'll be talking about financial metrics for product managers. So as a product manager, it is very necessary that whatever metrics you are delivering to the end customer, is it making any impact on the company, how much revenue it is getting. So let's start with the financial metrics. First metrics we have is the gross profit margin, which equals to your revenue minus the COGS, which is your cost of goods sold, to the revenue. So it tells us how much of revenue is profit after factoring in the cost of the goods sold. So let's say the revenue is 500 and the COGS is 300. So the gross profit margin would be 500 minus 300 upon 500, which would be your 40%. Next we have is the net profit margin. It tells us how much of revenue is profit after factoring in the total expenses. So here your total expenses include your COGS, your operating expense and any taxes. So net profit margin equal to your revenue minus the total expenses to the total revenue. Revenue is 500, total expenses are 450. So 500 minus 450 upon 500, which will be your 10%. A higher margin means that the company is managing its expenses well, but a lower margin means there is some inefficiency in the pricing or the production. Third we have is the working capital, which is your current assets minus the current liability. It's the operating liquidity that the company uses in the day-to-day to run its operations. So let's say the current assets are 500, liability is 300, then the working capital would be 500 minus 300, which would be 200. So a higher working capital means that the company is functioning very well and is able to run its daily operations. Fourth we have is the current ratio. It equals to current assets to current liabilities. So it tells us if there are any short-term obligations that are due within the current year. So let's say current assets are 500, current liabilities are 200. So the current ratio would be 500 upon 200, which would be 2.5. So a ratio greater than 1 means that the company is able to run its day-to-day operations well and is not there in any financial stress. Fifth we have is the quick ratio. So this liquidity ratio only uses high current asset values such as your cash or market securities and does not involve inventory. So it makes sure that the company is able to run its operation without selling its inventory. So if the ratio is greater than 1, that means that the company is doing well and would not have to sell any inventory. Next we have is the leverage. So leverage is equal to total debt to the total equity. It measures the company's financial risk by calculating the total debt, which let's say is 500 and total equity is 200. So 500 upon 200, which gives us 2.5. So if the ratio is greater than 1, that means that the company is in some financial stress. But if the ratio is less than 1, that means the equity is more than the debt and the company is able to run its operations smoothly. Next we have is the inventory turnover. So it equals to the cost of the goods sold to the average inventory. Average inventory here is your beginning inventory plus the ending inventory divided by 2. So let's say the COGS is 500 and the average inventory is 200. So in this case, the inventory turnover would be 2.5. So if the ratio is greater than 1, that means company has faster inventory sale and is replacing its inventory very soon. As soon as a new product is coming, the inventory is getting out. But if the ratio is less than 1, that means that the inventory is not being used by the company and it might affect any perishable inventory. So for a good operation, always the inventory turnover ratio should be greater than 1. So which will ideally mean that, let's say if I have a stock for 3 months, I am able to get that stock out in 3 months itself. Next we have is total asset turnover. It tells us how efficiently the company is using its assets to generate revenue. So it equals to revenue upon the starting asset and the ending asset divided by 2. So if the ratio is greater than 1, that means that the company is able to utilize its assets and generate revenue. But if the ratio is less than 1, that means the company is underutilizing its asset. Next we have is return on equity. So return on equity tells us how efficiently the company is using its equity to generate profit. It equals to net income to stakeholder equity. So let's say the net income is 200 and the stakeholder equity is 1000. So return on equity will be 200 upon 1000 into 100, which will be your 20%. Next we have is return on assets. So here instead of the equity we have the assets, how efficiently you are managing your assets to generate the profit. So return on assets equal to net income upon total assets. So let's say 200 upon 2000, which would be your 10%. So a higher value means that the company is using its assets in a good way to generate profit. Then we have is average monthly revenue. So let's say we have 500 customers who are paying us $50 per month. In that case, the company is earning 500 into $50, which is your $25,000 per month. So we say that the average monthly revenue of the company is $25,000. Then we have is the burn rate. So it tells us how much the company is spending on its expenditure. So let's say if the burn rate is $50, then we say that the company is spending $50 on its expenditure. So while running a business, what's the end goal? The end goal is to make money. So if we don't know the basic financial metrics, which are your like the profit margin, return on equity, or these terms, you'll not be able to successfully run a business. So same for a product manager. When I am delivering a product to the end customer, I definitely need to make sure that the customer metrics are met, but also the financial metrics are met. Hope you like this video. Stay tuned for more. Thank you.